The Federal Reserve has decided to maintain its current interest rates, despite pressure from President Trump for rate cuts, as it navigates a stable yet uncertain economic landscape. The decision comes amid steady unemployment and lower-than-expected inflation, although new tariffs and geopolitical tensions, particularly between Israel and Iran, pose risks to the economic outlook. Analysts are closely watching for any changes in the Fed's economic projections and rate forecasts, with market participants not expecting potential rate cuts before September. The escalating conflict between Israel and Iran has significantly impacted global markets, overshadowing the Fed's rate decision. Israel's military actions targeting Iran's energy facilities have led to a sharp rise in oil prices, with U.S. crude reaching $75.67 per barrel, and Brent crude hitting $77.90. This surge, the largest in 3 years, raises concerns about inflation and consumer spending, as further disruptions could drive prices above $100 per barrel. The possibility of Iran closing the Strait of Hormuz adds to the geopolitical uncertainty, although skepticism remains about its feasibility due to U.S. naval presence. The conflict has also affected stock markets, with significant downturns last Friday, followed by slight recoveries in futures. The Dow, S&P 500, and Nasdaq indices experienced declines, while the bond market saw an increase in the 10-year Treasury yield. In parallel, the U.S. is set to release key economic data, including retail sales and housing starts, alongside earnings reports from major companies, which will provide further insights into the economic landscape. The Fed, led by Chair Jerome Powell, is expected to hold rates steady while monitoring these developments closely.
In the first half of 2025, the Australian Securities Exchange, ASX, has notably outperformed the U.S. stock market, specifically the S&P 500, amid global economic uncertainties driven by former U.S. President Donald Trump's unpredictable policies. The ASX 200 index rose by 4.2%, compared to the S&P 500's 1.9% increase. This shift marks a departure from previous years where Wall Street, buoyed by tech stocks and AI advancements, led global gains. The ASX's strong performance is attributed to various factors, including Trump's erratic policymaking, such as trade tariffs and controversial immigration policies, which have increased volatility in U.S. markets and prompted investors to seek more stable alternatives. The ASX's resilience is further supported by its market composition, which is heavily weighted towards banks and mining sectors, contrasting with Wall Street's tech-heavy focus. This sectoral difference has made the ASX more appealing to global investors, including large institutional investors and pension funds, who are diversifying away from U.S. equities amid heightened risks. Additionally, expectations of interest rate cuts by the Reserve Bank of Australia, RBA, have bolstered the appeal of Australian equities. Despite the current trend favoring the ASX as a relative safe haven, experts caution that the interconnected nature of global economies, particularly between the US and China, may still impact Australia's economic outlook. Nonetheless, Australia's stock market continues to benefit from its perceived stability and strategic positioning in the evolving global investment landscape.
The geopolitical landscape surrounding critical minerals is intensifying as global demand, driven primarily by the clean energy sector, is projected to surge significantly. According to the International Energy Agency, the need for these minerals could double or even quadruple by 2040, with electric vehicles and battery storage being the primary demand drivers. Key minerals such as lithium, graphite, copper, and nickel are at the forefront, with lithium expected to experience the fastest growth rate. This surge underscores the importance of securing reliable supply chains, as these minerals are not evenly distributed globally, posing potential geopolitical and economic challenges. China currently holds a dominant position in the global market for critical minerals, controlling a significant portion of the refining capacity for rare earth elements, cobalt, nickel, and lithium. This dominance presents a strategic leverage point, as China could potentially manipulate supply chains for political gain, creating vulnerabilities and uncertainties in global clean energy markets. The uneven distribution of these resources could lead to economic disparities, with developing countries bearing environmental burdens, while wealthier nations benefit economically. The situation is further complicated by protectionist policies and tariffs, raising concerns about potential supply chain disruptions that could impact global efforts to combat climate change.
The federal government has announced an increase in fuel prices, with petrol rising by 4 rupees and 80 paise per liter to 262 rupees and 59 paise, and high-speed diesel by 7 rupees and 95 paise to 258 rupees and 43 paise per liter, effective from June 16, 2025. This decision follows a previous minor hike of Re1 and occurs despite largely stable global oil markets. The increase is expected to significantly impact the economy by straining the budgets of middle and lower middle-class households who primarily use petrol for commuting. Additionally, the higher cost of high-speed diesel, essential for the transport sector and agricultural machinery, is anticipated to drive inflationary pressures. This could lead to increased prices of essential goods, such as vegetables and food items, due to rising transportation and production costs, potentially affecting overall economic stability and consumer purchasing power. In a broader economic context, the finance minister has emphasized that the budget aims for structural reforms and fiscal signaling, with plans to expand the tax base to include luxury items and clean energy imports. Despite the inflationary concerns associated with rising fuel costs, the stock market has shown resilience, with the KSE 100 index increasing by 2,328.24 points, or 1.91%, to settle at 124,352.68, indicating investor optimism.
Ripple's XRP is facing a potential challenge from a new entrant, Remitix, which is being dubbed by some analysts as XRP 2.0. Ripple recently made a significant move by acquiring Hidden Road, an institutional brokerage, for $1.25 billion, aiming to enhance its XRP ledger with post-trade services like clearing and settlement. This acquisition aligns with Ripple's ambition to capture a significant share of SWIFT's global liquidity market, which could transform XRP from a mere cross-border token to a major player in international finance. Despite these strategic advancements, XRP's price has seen only a modest 2% increase over the past week and remains volatile, raising concerns about its stability and long-term value. Meanwhile, Remitix is gaining traction with its focus on crypto-to-fiat remittances, offering a seamless and compliant service that allows funds to be sent in crypto and received as local fiat currency without the need for complex wallet setups. With support for over 30 fiat currencies and 40 crypto assets, Remitix is already operational and has raised $15.5 million in its pre-sale phase, positioning itself as a practical alternative to Ripple's promises. As Remitix continues to deliver real-world utility that Ripple has long aspired to achieve, it could potentially capture a significant portion of the market that Ripple is targeting, making it a noteworthy contender in the evolving crypto landscape.
Marc Andreessen, co-founder of venture capital firm Andreessen Horowitz, has issued a stark warning about the escalating competition between the U.S. and China for artificial intelligence, AI supremacy. Drawing parallels to the Cold War, Andreessen emphasized the strategic importance of AI as a control layer across all societal functions, including education, healthcare, and transportation. He raised concerns about the potential for Chinese AI, infused with Marxist ideology, to dominate global systems, thereby influencing societal structures worldwide. This perspective aligns with views from other tech leaders like Vinod Khosla, who also highlighted the geopolitical and economic implications of AI leadership, particularly the potential for China to leverage AI to extend its influence globally. In response to these concerns, the Trump administration has taken proactive steps to bolster the U.S. position in the AI race. Key measures include repealing previous restrictive AI diffusion regulations and forging significant agreements with Saudi Arabia and the UAE, facilitating the acquisition of advanced AI technology and infrastructure. These deals, involving substantial investments in NVIDIA semiconductors and data centers, aim to strengthen U.S. alliances and maintain a competitive edge in AI development. The strategic partnerships underscore the high stakes of the AI race, with economic and geopolitical power dynamics hinging on technological advancements and influence.
The U.S. Export-Import Bank, EXIM, is considering a significant financial investment in Greenland's mining sector, with a potential $120 million loan to Critical Metals Corp. For its Tanbreez Rare Earths project. This move marks the Trump administration's first overseas mining investment, reflecting a strategic effort to secure U.S. access to critical minerals amid global trade tensions. The loan aims to reduce U.S. dependence on China, which currently dominates the rare earths market. If approved, the loan would support the development of the Tanbreez mine, expected to commence production by 2026, producing 85,000 metric tons of rare earth concentrates annually. The EXIM loan is part of a broader U.S. strategy to diversify supply chains for essential minerals used in high-tech and defense industries. The initiative aligns with recent geopolitical maneuvers, including efforts by the Biden administration to prevent Chinese acquisition of the Tanbreez project. Despite the promising financial backing, critical metals must secure additional strategic investments and potentially develop a processing facility in the U.S. to fully capitalize on the EXIM support. This development underscores the competitive international landscape for rare earth resources and highlights the U.S. government's commitment to fostering domestic capabilities in critical mineral processing.
Oracle co-founder Larry Ellison has surged to the position of the world's second richest individual, amassing a net worth of $258 billion after Oracle's shares experienced a significant rally. This leap in wealth, amounting to $40 billion in just 2 days, was driven by Oracle's robust quarterly earnings that surpassed Wall Street expectations. The company's stock rose 13% on Thursday and an additional 7% by mid-Friday, reaching a record high of approximately $215 per share. Ellison's fortune is largely tied to his 41% ownership in Oracle, which has seen its market capitalization increase by $104 billion, surpassing the total valuation of major companies like Intel and Nike. The substantial growth in Oracle's share price is attributed to the company's strong performance in the cloud infrastructure sector, particularly in supporting artificial intelligence AI workloads. Analysts have described this earnings announcement as a pivotal moment, with expectations of accelerated growth in Oracle's fiscal year 2026. The company's strategic positioning in AI and cloud infrastructure, along with its role as a hosting provider for TikTok's U.S. user data, underscores its influence in the tech industry. This development not only highlights the increasing investor interest in AI infrastructure, but also solidifies Oracle's status as a key player in the evolving landscape of enterprise computing.
The recent trend of banks adjusting interest rates on savings accounts more aggressively than reductions in the Reserve Bank of Australia's RBA cash rate has sparked concern among savers and analysts alike, as the RBA has been cutting rates since February. With expectations of further reductions, banks have been observed employing complex repricing strategies to protect their profit margins. This involves offering less favorable terms on savings accounts, such as reducing the base interest rate while adjusting bonus rates, making it challenging for consumers to discern the actual returns on their deposits. This tactic allows banks to maintain appealing advertised rates while effectively reducing the actual interest paid to most savers. The Australian Competition and Consumer Commission, ACCC, highlighted the complexity and opacity of the retail deposit market, which makes it difficult for consumers to compare savings products effectively. The issue is compounded by the fact that a significant portion of bonus saver account holders do not receive the advertised bonus rates due to stringent conditions. In response, the government has mandated greater transparency from banks regarding changes in interest rates on savings accounts. Analysts, such as those from Morgan Stanley, note that banks are increasingly relying on deposit pricing strategies to manage returns and margins, marking a shift from their previous reliance on mortgage pricing power. This development underscores the growing disconnect between the rates banks promote and the actual earnings of customers, complicating the impact of monetary policy on household finances.
Foreign portfolio investors, FPIs, injected 3,346.94 crore rupees into Indian equity markets last week, according to the National Securities Depository Limited, NSDL. This influx was largely attributed to positive investor sentiment following the Reserve Bank of India's RBI unexpected decision to reduce the repo rate by 50 basis points to 5.5%. Despite this positive weekly inflow, June's overall FPI investment remains negative, with withdrawals totaling 5,402 crore rupees so far this month. Notably, a significant withdrawal of 3,275.76 crore rupees occurred on the last trading day of the week, highlighting the volatility in foreign investment flows. The RBI's rate cut, announced during the June Monetary Policy Committee meeting, aims to stimulate economic growth and boost investor confidence. This move comes after a robust month in May, where net FPI inflows were recorded at 19,860 crore rupees, marking it as the strongest month for foreign investment in 2025. However, the volatility seen in June reflects broader market uncertainties and the cautious stance of investors amidst fluctuating global economic conditions. The situation underscores the dynamic nature of foreign investments and their sensitivity to monetary policy changes, which can significantly influence market sentiment and capital flows.